Hi folks, and welcome back to Meaningful Money. Okay, it's looking like it might rain, so I better crack on. I'm going to talk this time about hedge funds, carrying on our little series about asset classes. Talked about gold last time, and it's the turn of hedge funds this time. Interesting noise going on the road behind the hedge, just behind the camera, but not to worry. We're updating some of the really early videos where the audio and video quality was a little bit ropey, so hopefully you'll agree it's somewhat better now. But before we dive into the content now, let's just say thank you to my friends down here in the bottom right. That's 7 Investment Management, who continue to sponsor me, for which I'm very, very grateful. Now, hedge funds as an asset class are misunderstood. Many people, of course, will have a clue what they are. But they tend to have had a bit of a bad rep, and they particularly had some bad press in 2008 and 2009, where stock markets generally were on the slide. Some people blamed hedge funds, at least in part, for contributing to that. And the reason for that is that hedge funds are designed to do well when markets are going down. What? How on earth does that work? Well, I'll come back to that in a minute, but because of that, they are risky assets, right? They're not for the faint-hearted. They're particularly risky in isolation. They tend to invest in perhaps smaller company shares, distressed company shares. That's one of the ways they make money. But as a small part of your portfolio, they can actually reduce the risk because, again, they are a diversifier. They spread the money. If you hold hedge funds and gold and shares and all sorts of stuff, it's another way of spreading your money around into something which behaves differently to anything else. So therefore, it's a good diversifier. One important thing, though, is that hedge funds can gear. That means they can borrow money to invest. Borrowing money always amplifies risk, all right? So just something to be aware of if you're considering investing in hedge funds of some kind. They can gear, and that increases the riskiness. Hedge funds have all kinds of tools that they use to make money, but the one that they're best known for is something called short selling, and it was that practice which gave them a lot of bad press in 2008 and 9. Now, short selling works like this, okay? Let's say you have some shares. You've got 100 shares in, ABC Limited, and they are worth £10 each. But I'm a hedge fund manager, and I think that those shares are going to go down in value. Perhaps I've seen a profit warning or something, I think they're going to go down. So I ask you, can I borrow your 100 shares? Can I just borrow them for a month or 2 months, something like that? And you say, yeah, okay, but I'll have them back. And I say, no problem, I'll give you them back. So I borrow your 100 shares worth £10 each, and I sell them in the market, all right? So I'm now sitting on £1,000 cash because I've sold your 100 shares at £10 each. The shares do go down in value. And they go down, instead of being worth £10 each, they're now only worth £5 each. So they've halved in value. Well, I've got £1,000. I use half of that to buy your 100 shares back, because that's only going to cost me £500 now. I buy your shares back and I give them back to you. You have a little fee as well for the sort of privilege of being the lender in the arrangement. But I'm now sitting on £500 profit. And you see that? Because I borrowed them off you, sold them high, bought them back low, and given them back to you again. And the difference in price between what I've sold them at and bought them at down here is my profit. That's all well and good when it works. But the problem is, what if I'm wrong about the share price going down? Well, if they go up, I've got your £1,000, but I'm going to have to add some money to that to buy your shares back and give them back to you after 30 or 60 days or whatever. So it's very much a gamble. Hopefully it's an educated gamble. But if I believe shares are going to go down, short selling is one way I can make money from it. So, it works when it works, like all investment, I suppose. When it doesn't, it can not work fairly badly. So something to be careful of. Last thing you need to know about hedge funds, really, is that they are very expensive. Most hedge funds work on something called a 2+20 rule, which means you pay 2% sort of annual management charge on whatever you've got invested with them, and then you pay 20% on any profits they make. So you only get to keep 80% of the profits. 20% of it goes to the hedge fund manager. That's why hedge fund managers drive really nice cars, right? So, they're expensive, they're risky, they use different kind of methods to most other asset classes, but they're a useful diversifier and can actually reduce risk if you hold them in tandem with all these other things. Right, so that's hedge funds. Leave any comments or questions under the video here as usual. I'll do my best to answer them. Going to wrap up the asset class series next time and look at all the others. I'm going to move on, I think, because it is just starting to rain. Thanks for watching, and I'll see you next time.